Guys, we have 5 top stocks trading their 52-week low that super investors are buying. Now, real quick before we reveal those, a super investor is an investor who has outperformed the market over the long period of time. And some examples are Warren Buffett, Michael Burry, Seth Klarman, and friends of the channel like Guy Spear and Monish Pabrai. Now, one thing to keep in mind is their recent performance might not be as good. And a lot of people in the comments say, they've been sucking for the last 3 or 4 years. Yeah, they have been, a lot of them. But just like everybody compared Warren Buffett to Cathie Wood, and then all of a sudden Warren Buffett's performance has drastically outperformed Cathie Wood. So just keep in mind that a super investor is someone who doesn't care about how they're doing in the short run. What they care about is the long run, 10, 20, 30 years. Stock number 1, EXP. Eagle Materials. Let's pull this bad boy up. It's a $6.6 billion market cap. PE 14, price of free cash flow 18. So their current free cash flow is lower than last year's net income, but the 5-year average free cash flow is greater than their 5-year net income. Enterprise value, $8.4 billion versus $6.6 billion market cap. Solid returns on capital, which super investors love. Let's see what else here. Decent margins. Well, that's interesting. Gross margin of 30% and a bottom line profit margin of 20%.
That's good.
I mean, Mo, how do you even have that? How do they produce something at a 30% gross margin and then after paying taxes and everything, have a 20% profit margin? That seems interesting. Let's look at their pillars. Oh boy, look at this, Mo. Look at these pillars.
I haven't seen that in a while.
I know, 8 pillars. They bought back 21% of their shares outstanding.
Jeez.
Right, and investors love this. Super investors will love this as long as they're buying back cheap shares. That is the key there. Now, remember, we're looking at all these things, and cash flow growth, something I don't like here. Well,
what's that?
You know, their cash flow growth in the last 5 years was 86 million, net income growth of 390. But like we always say, they should equate each other over long periods of time, and that's what's happened here. I mean, they're very close to each other. They're within 10%. I always hear a lot of super investors say that they want to be within 80%. Free cash flow be no less than 80% of net income. Because remember, if you're investing in the business in capital expenditures, that's going to drive down your free cash flow. Let's see what analysts are saying about the company. Man, look at this. Solid growth in EPS, $14.50. What was that?
It's good growth.
Yeah, to 15.5 to 17. Now, guys, this is only a $6 billion company. So now aren't going to be many analysts looking at this thing. I'm actually surprised it's 14 analysts here. And revenue growth, 4 or 5% a year. Nothing to write home about, but nothing bad, right? Yeah. Now remember, we like looking at 52-week low stocks because in the short run, if a stock is hitting new lows, there could be an emotional reason for that, not a fundamental reason. So it doesn't mean just buy a company because it's a 52-week low. Whenever I hear people say, oh, I'm buying this company because in the last year it hit a peak of 100, now it's at 50. I'm like, well, that's a stupid reason, right?
Yeah, I remember that happened with Peloton back in the day.
Oh, that's right.
180, and I think it went to 100, and everyone's like, buy, 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 and next thing you know, it's at 5.
Actually, yeah, that's exactly right. What is Peloton at right now?
That's exactly what happened.
$7.
Yeah, but this was that was a real conversation that was being had in 2022, I think.
And the example I always give to people is if all it mattered was a discount to a high, great. If I have a home that's worth $1 million and I ask 10 million for it, nobody buys that, drop it to 5. Does that make it a good deal?
Yeah.
No. And by the way, this is very triggering for Mo because Mo was just trying to sell a house for an egregious number, and he finally sold it for a reasonable number.
No, I think the listing price was too high, and I'm happy with the price.
Yeah, exactly.
Yeah.
I thought you were going to tell me that you're.
No.
I thought you were going to pull a Trump comment and be like, "This is the best house in the world."
Well, it is, and yeah.
All right, so. Mo, can you take a look? Because one of the things we talk about on this channel, and people will sit there and say, why do you believe in trading when you're a value investor? Guys, Michael Burry is big on trading.
Yeah.
I look at trading as something that you can do with anything. You can trade Bitcoin. What matters is the charts here. And I do believe in that. And I've seen many successful people make money in trading. So Mo, why don't you look at the charts here for EXP and look at it from a standpoint of the charts?
Yeah, so it's interesting that it's at those 52-week lows. I actually, based on the charts, I would, if I was betting, I would say this is probably pretty damn close to the low. I would say the low that it could probably get to, unless something crazy happens. News can happen, anything can, $193, $194 a share. And we're at $199 right now. 190, yeah, about 199. So I think this is a really good opportunity. If you want to say, hey, we're 52-week lows, this is a good company, we're going to look at stock analyzer tool, et cetera. But this is very, very interesting. It's very interesting.
All right, so now remember, it says, as Mo said, stock analyzer tool. It's putting the story with the numbers. A lot of people just invest in the story. They're not investing, they're speculating. Because a great story is awesome, but without the numbers, it's a fairy tale. And you're going to make a lot of mistakes because the fifth pillar in our principle-driven investing is probably the most important one. A great story can become a bad investment if you pay the wrong price. And when you're attached to a story, you're never ever going to think that the price matters. Even though you think it will, but you're just going to make it relative to where the price is today. We don't want you doing that. So I bring the stock analyzer tool. I pull up 10 years of analysis. You can do 1 to 20. So here are my assumptions. And Mo, tell me if you think I'm wrong on this one.
Okay.
I did 3, 5, and 7% revenue growth. I feel it's reasonable.
Why is the revenue growth like 0 right now?
Well, we saw that in there. I don't know because maybe there's a slowdown going on because we have seen that in other consumer companies.
We've also seen, I mean, this is building materials. We saw the big spike and coming back to reality.
Right.
Okay.
Profit margin, I did 17, 20, and 23, and same with free cash flow.
I like it.
PE, got good returns on capital that seem to be getting better.
Yeah.
So I did 14, 17, and 20.
Okay.
Guys, remember, I always start at 15, and then I look at returns on capital and growth rate. If it's a good company with higher returns on capital, better growth rate, I go higher. If it's worse, I go lower. Here, you got good returns on capital, but the growth is kind of okay.
Yeah.
So I think 14, 17, and 20 works.
Fair.
Desired return, 9%. Remember, guys, this is 9 or 10% is basically what the market's going to get you. So if you want to buy an individual company, you got to have margin of safety. And that margin of safety is in desired return. I'm just putting this in here to say, hey, what's the company worth based on an intrinsic value? For me, that's 9%. So I hit the analyze button. Boom. I have a low price of 170, a high price of 388, a middle price of 260. And Mo, the interesting part is at 260, this is looking like a 13% annualized return.
Solid.
Yeah, it's not bad. And I understand now why some super investors are interested in this company.
Yeah.
And more specifically, Seth Klarman has this stock. Now, Seth Klarman has done very poorly as of lately as an investor. But guys, every great investor goes through a bear market at some point.
Maybe this is a turnaround play.
This might be the turnaround play. Stock number 2, Kraft Heinz. Guys, this is a company that Warren Buffett was heavily involved with, and him and Bill Gates are some of the super investors involved. Now, $31 billion company, a lot of debt. $70 billion enterprise value. This difference here is the debt. That's always like surprising me when I see a Warren Buffett company with a lot of debt, because he always talks about how you don't need that. Now, one attractive thing is 10 times price to free cash flow, 11 times PE. There's a lot of benefit. There's a lot of positivity here. Now, Kraft Heinz, where is that going?
Nowhere.
Unless their debt is insurmountable and they have problems there. Because people aren't going to stop purchasing what my grandson calls red dip. He calls ketchup red dip.
Maybe they should brand it that way.
Red dip. Red dip. Gross margin of 35%. Not much growth here, Mo. Look at this revenue growth. In the last 3 and 5 years, is basically nothing.
Yeah.
This is not an attractive company.
Their
Look at
ROIC is weak.
these low returns. I'm surprised that Warren Buffett owns this.
Yeah, me too.
This is very, very the huge dividend. Wowza. 6% dividend yield. Eats up $2 billion of their $3 billion in cash flow. You know what the funny part is?
What's that?
These guys own this company, and I would immediately just say, I'll find something else. Like, I look at this immediately and think, I'm going to find something else. Because I look at this, I mean, it's 6 pillars of the 8, but a lot of debt, low return on capital.
And it's not like they're buying back a ton of shares.
Right.
That makes it interesting. Like, what? I don't get the appeal.
So that's the other thing, Mo. You're right. Why not buy back a ton of shares if it's selling for 10 times earnings and 10 times free cash flow?
With how bad these metrics look, you could really do very well there.
Well, the question is, what about this debt level? Do you want to just pay down debt? I don't know the terms of this debt.
I think there's 2 better things that you could be doing with that money.
Buy back shares.
Buy back shares or pay down debt.
Yeah.
Definitely not pay a dividend. But they probably don't want to pay a dividend because it's going to crash the stock.
They don't want to stop paying the dividend.
Correct.
Because people, all right, let's see what analysts are thinking about this company.
It's probably a lot of grandparents' favorite company.
Yeah. All right. From $260 a share, $269, $283, $325, $341. I mean, it's growth. Revenue, ish.
Yeah, ish.
Growing 25 billion to 20. I mean, this is not a, maybe this is part of the reason why. Let's go to our stock analysis. Actually, let's do the charts first.
So this was another interesting, actually, this is getting really close to COVID lows. COVID low was about $20 a share. But again, this is almost the same thing that I drew on the last chart. I do think this is really near a low. I don't think it's going to get to COVID lows unless the entire market falls apart. But for the meantime, it's just going to probably sit here about $26, maybe $25. So again, it's something that you can look at a chart and say, okay, I see a pretty realistic bottom unless news happens. And if you couple it with something like this, maybe it's an opportunity to go start acquiring some shares. But that just because we do have a 52-week low and I'm saying there's a support level here, doesn't mean go buy it. I just want to make that very clear to everybody.
Yeah. All right. So from a stock analyzer perspective, I'm doing a 10-year analysis. Mo, I don't know how a Kraft Heinz business has 0% revenue growth for 10 years. I don't even know how it does 2%. Because you got to think with inflation, especially something so
Ingrained,
yeah, in our eating,
yeah,
that you would think they would have at least be able to keep up with inflation and be able to get 3 to, I mean, I don't know, let's see. Let's go 0, 3, and let's go 1, 3, and 5% revenue growth. Profit margin, I did 6, 7, 8%, even though last year they did 10%. Free cash flow, I did 8, 10, and 12%. So they have better free cash flow than profit margin. That's something huge here. PE, I did 14, 16, and 18 because it's got low ROIC, but it's Kraft Heinz. Like, how's it going away?
I'm looking at their product list right now. I don't understand. Kool-Aid, Crystal Light, A1 sauce, of course, all of the sauces, ketchup and stuff, Velveeta, Lunchables.
Lunchables?
Yeah. Grey Poupon, Jell-O, Cool Whip, Country Time. I don't get it. How do you have, like, no revenue growth?
That's why I'm giving it the 14, 16, 18 times multiple here. And, of course, our 9% desired return. The stock's at 26. Let's see if there's a reason why Buffett holds it.
I was expecting better.
Now, guys, remember, these current returns include the dividends. So don't add the dividend on top of this. But I see a low of 16 to 20, a high of 33 to 50, a middle of 23 to 33. So I guess it becomes, like, for me, the debt is an issue. I'd have to understand that debt more. And 12.84%, I'd rather have Eagle Materials.
Yeah. I actually
maybe not. I don't know.
All of those things, plus I don't agree with management. Like, they're just not
buying back
they're
shares?
just not good managers of capital.
Yeah, so that's a big thing for us. Stock number 3, Copart. This is an online, like, salvage company, but this is what I like about this company so much. $48 billion market cap, Mo. Enterprise value lower than their market cap. This means they have more cash on hand than total debt. They could take all their cash and current assets, pay off all their debt, and still be left with more money. That is what's incredible. Now, here's what's interesting to me. Price to free cash flow, 40 times. Price to earnings, 32. Significantly lower free cash flow than their net income. So there's like 7 or 8 value investors who have this. Super investors, I should say. Francis Roshan is one of them. Very well known. So I don't know if I see this, Mo. Good gross margin, 45%, with a profit margin of 30%. So here we are. We've got a lot of X's here. Their shares outstanding have been up. High returns on capital, though, Mo, 13.5%.
Good compared to Kraft Heinz.
Solid compared to Kraft Heinz. Free cash flow is up almost $1 billion in the last 5 years, $800 million net income. Great revenue growth, like we said, very little debt. All right, so I'm not opposed to this. Let's go to analyst estimates. High single digit, low double digit growth. Revenue growth. So this is what's interesting to me. Earnings per share growth of 10 to 13%. They have good gross margin of like 45%, good bottom line margin, and yet look at their revenue growth. You would think with this revenue growth that their profit growth would be, their earnings growth would be much higher. Because if you're growing at 10%, you have such a high gross margin, your profit growth should be much higher.
Yeah.
So that's confusing me. Like, where are these analysts getting these ideas from?
Right.
Who knows? All right, Mo, take us to the charts.
So I drew 2 yellow lines here, and these kind of show the next support level. So as you can see, one is about $46. The other one's probably $45, $44 a share. So again, you can kind of see these support levels that are coming down. I think it would be very hard pressed. Again, it's a market event, a total market event if this thing starts coming down below $40, especially into this $29, $30 range. Guys, if you like what I'm doing here and I'm showing you these different things on a chart, just something that you could supplement in, I invite you to come over to the trading channel. Just search my name, Mustafa Hussein. The link is also in the description below. We talk about every single thing trading. It's not just these support levels. It's very, very simple. My theme to everything is keep it simple, stupid, and that's exactly what we do over here. And I think that's what we do on this entire channel, on everything money, period. It's always keep it simple, stupid.
We've always found that simplest ideas work the best. You know, even in terms of like our stock analyzer, I remember telling one of my friends who is a value investor about it. He's like, well, I do think you should build a model, but you really got to understand, blah, blah. I'm like, well, but if every investment's the present value of all future cash flow, and he agreed with that, and it's all about understanding that future, then this is it.
Yeah.
But you do have to understand the story about merging the story with these numbers together. So here are my merges of the numbers. And I think this is a little aggressive. I did 5, 8, 11% revenue growth for the next 10 years. Profit margin, I did 27, 30, and 33, and free cash flow 20, 23, and 26. So one of the first things I want to do is understand why there's such a big difference between free cash flow and profit, because they should be very similar over long periods of time. PE, I did 14, 17, and 20 because of these pretty decent 5 and 10 year returns on capital, and then my 9% return.
Okay.
I think these are reasonable. Let's hit the analyze button. The stock's currently at 49. Yeah, this is just telling me to wait.
Yeah.
16 to 20 on the low side, 40 to 50 on the high side, 26 to 34 in the middle. Now, obviously, you're going to put your numbers in, and you're going to, if you know something better than I do, please put it in. But for this company, and I don't know when those people bought, those might be, those super investors who bought might be long-term buy and hold people, just like Sprouts.
Yeah.
We bought Sprouts low 30s. It's currently at 170. I ain't selling, but I'm not buying Sprouts at 170, right?
Yeah.
Okay.
Definitely.
So that's the big key to understand when you try to follow these value investors. Make sure you look at what they've been doing for a long period of time. Now, stock number 4, a local company to Northeast Ohio, Smuckers, JM Smuckers, SJM, $10 billion market cap. And Mo, just like Kraft Heinz, a lot of debt. $22 billion in debt. Free cash flow, much bigger than your net income. So look at this net income here, Mo. 5-year net income of 377, negative 250 last year. And look at this free cash flow.
Wow.
So is this something that investors are missing because they're focused on negatives here versus 12 times free cash flow?
Huh? Okay.
With a 4.5% dividend that eats up half their free cash flow.
I don't like that.
Low returns on capital, which seems to be about par for the food business.
Yeah.
Let's see their acquisitions. Okay,
that's an interesting thing.
What is?
What you just said. If that's consistent with the industry, maybe you don't put a super amount of weight into it saying...
But you still should have a lower...
You should.
But look at this. 5-year net acquisitions of $2.5 billion. So I want to sit there and factor that in because if you look at this revenue growth, it's not very good. 3.7% the last 3 years, yet they have all these acquisitions. So really the revenue growth seems to be might be driven by these acquisitions, which is not the best. So let's see here. Let's look at the 8 pillars. Oof.
Bad.
5 X's, 3 checks. But again, so cash flow's down in the last 5 years. Revenue's up. Why would that be? I don't know. A lot of debt. Let's see what analyst estimates are saying. Basically nothing in terms of earnings per share growth. And revenue growth, very low. Oh boy, this is an ugly looking business.
Yeah.
I wonder what the reason is for all of this. Return on equity is low and bad. People are going to love that dividend. 4.5% dividend yield. They're going to love that dividend.
I know. This is another one of those stocks that older people will like. Just keeps paying.
All right, so what did the chart tell us, Mo?
So this is very interesting. We're at not only a 52-week low, but if you just, so this is 2018 right here, this bottom, and if you just keep scrolling, this comes back to 2014, 2013. So I like going back and looking at all time. I'll go back to 2000 and look at it. This to me is probably the low, and it has a very, very strong history of saying, okay, this is the bottom. Now, at the same point, it doesn't really go up and down that much. So this is more of a stock that's going to consolidate for you. So it's going to probably bounce between $95 and $120, and it'll just stay in that range over a long period of time. Did it peak out once before? Yeah, it did to the top, but this is like a dinosaur stock. It's like an AT&T. It's like, I don't know what other dinosaurs are out there. They don't move much. They just sit there.
So if you're interested in dividends and you want to get that consistent, I mean, they're only eating up half their free cash flow with dividends, but you got to remember their free cash flow. If you look right here in our stock analyzer, their free cash flow is
very solid.
Yeah, 9 to 11%.
Yeah.
11% in the last 10 years. It's been declining lately, so you have to watch for that. Is this part of a trend that's continuing?
Yeah.
So I did 1%, 3%, and 5% revenue growth because, again, I don't know how I can still do 1% a year. Last 10 years has been much better in terms of revenue growth, 5% a year. So I still did 1%, 3%, and 5%. I did profit margin of 5.79. I'm pretty much going to ignore profit margin.
Yeah.
Free cash flow margin, 9, 9.75, and 10.5. Now for PE and price of free cash flow, I did 12, 15, and 18. Not a sexy company.
No.
Low returns on capital. Probably a more capital intensive business because when you're doing food products, you got to have manufacturing and all that stuff. And then I did my 9% return.
This is going to be interesting to see.
Now, before I hit the analyze button, guys, remember, we have to put good assumptions into the stock analyzer tool. This is part of the art of investing. You have to get a feel for things. We have people in the community always sharing their stock analyzer assumptions. You don't want to be too conservative, you're losing out every deal. You don't want to be too aggressive, or you're overpaying for everything. The key is to find that happy medium. That takes a little bit of time and a little bit of experience. And so far, we have analyzed 4 great companies that super investors love, but I don't care how great a business is. I'm not just paying any price for it. That's not how real investors are going to build wealth. You need to understand the business, valuation, and how the system works no matter what the market's doing. And part of understanding the business is looking at the future. What does that future hold for it? Now, back in April, the market pulled back and there was a lot of fear. Headlines went nuts. Most people froze, but not us. While they're panicking, we sit there and stick to our plan of what we're looking for and to purchase more of it if the price gets attractive. That's going to be the case no matter what the market is doing. But Paul of 20 years ago was a lot more like the average person out there. I would chase stocks, I would follow tips, I would get caught up in the hype. And I believed that a great story meant a great investment. And I was just hoping that something great would stick. That's not investing though, that's gambling. And I learned that the hard way. And that's exactly why we created Everything Money. We wanted to give people like me of 20 years ago the tools and the strategy and the community I needed and wish I had back then in order to get better at investing. If you're joining Everything Money, it gives you access to all of our software, a private group of serious, like-minded investors who are trying to avoid the guesswork. But let's be very, very clear. We don't just want anyone to join. If someone out there is the kind of person that wants to jump from one shiny thing to the next, this is not the place for you. In fact, you should just avoid our channel altogether. If you're not willing to put in the time, follow the process and stick with it, this is not the right place for you. We're trying to build a community of committed investors who are in this for the long haul. If you've made it this far in the video, that's highly likely to be you. So go start that 7-day trial right now. Click the link below. Just know, not only are spots limited every day, but we don't know how long we're going to keep this trial open because there's been a lot of internal discussions about making this an application kind of software. We want to get people who are so serious to join a committed community that they're going to sit there and apply for it. So if you're serious and you want to avoid that, now's the time. So hit the analyze button. The stock's currently at 95. I have a low price of, let's focus on the free cash flow. 88, high price of 172, middle price of 123. With a 12.8% return based on the current price and based on cash flow.
All right.
Not bad.
Not bad.
I can understand somebody making the argument for this today.
Yeah.
So I don't think you should sleep on this, but the question is this enough juice for the squeeze based on their debt levels, correct?
Yeah, exactly.
Stock number 5, Pepsi Cola. By the way, I'm a Coke guy. But I will say, Pepsi Zero Sugar is phenomenal. Have you had it, Mo?
No.
You've had Pepsi, you've had Coke Zero though, right?
Yeah.
You like it?
Yeah.
Now guys, what's interesting about Pepsi also, look at this 5-year chart. It's even. Absolutely even. Now, they do pay a dividend, so I'm sure along the way you're getting, I mean, look at this dividend yield, Mo, 4%. It eats up, oh, but this I don't like, guys.
Oh my God.
7.3 billion in free cash flow last year, 6.75 over the last 5 years. The dividend cost them 7.34 billion. How do they afford this dividend?
That's insane.
Because a lot of people would focus on their net income and say, okay, it eats up a big chunk. Guys, how are they affording this dividend?
We don't see that often.
We do not see that often. Good solid revenue growth though. 4% in the last 3 years, 6% a year over the last 5 years, 3% in the last 10 years, with not much in acquisitions. Only $4 billion on a $180 billion market cap.
Good ROIC too.
Good ROIC. Yeah, great ROIC and increasing. Okay, so Mo, I'm skeptical of this dividend.
Yeah, me too.
I don't know about this one.
I mean.
Now in our community, so we have a community stock rating here. We have 50% have it as a buy, 50% have it as a hold.
Huh.
That's interesting.
That is.
That's very, very interesting. Man, this is a flat stock for the last 5 years.
Pepsi.
This
is a staple.
8 pillars. All right, we got a high price to free cash flow because that free cash flow is lower than net income. We've got a lot of debt, which doesn't bother me so much because it's Pepsi. It's kind of like, you know what? The Pepsi brand alone is worth how much money?
Yeah, you're not recreating it.
Yeah, so, okay, I'm fine with that. Let's see what analysts say. Okay, solid EPS growth, 6, 7, 8% a year, 6%, 7%, 9%, 6%, and revenue growth, 3, 3.5, 7, 7%. All right, so what are the charts telling us about Pepsi, Mo?
5-year low. Like, we are going back to here. This was COVID right here. This is the big drop in COVID. But again, you can see a very, very strong support level. So I would say, yeah, it's probably near its lows. What's probably going to happen, it's just going to hang here. And eventually it'll start to creep back up. I do not see it going down into this $100 range. It's $130 a share unless there's, again, a market event that happens. And that's consistent with all of these stocks. If a market event happens, you're going to see them fall to their previous lows. And most of these are at a low that has gone back 5, 10, 15 years in many cases.
God, that's incredible.
It is incredible.
But what kind of world do we live in where Pepsi's gone in 10 or 20 years?
Probably a nuclear world.
Yeah, probably.
Did you watch Pepsi? Where's My Jet?
Oh yeah, it's the best. It's
so good.
It's such a great documentary.
It's so good.
So good.
It's on Netflix if you want to go watch it.
I don't know if I want to reveal what was said, but in it, yeah, I'm not going to reveal it, but it's well worth the watch. Absolutely go watch it. It was great.
Yeah,
so please do that. So we're here with the stock analyzer tool. Mo, 10-year analysis. I did 2, 4, and 6%.
Okay, fair.
I think it's reasonable.
Yep.
Profit margin, greater than free cash flow. I did 9.75, 10.25, 10.75, and for free cash flow, I did 7.5, 8, 8.5.
Okay.
PE, 17, 20, and 23.
I like it. Should pay a premium for a brand like this.
And I could understand somebody said 20, 23, and 26. Yep. I really don't know what the right number is here.
Yep.
I did my 9% desired return. The stock is currently at 131. I hit the analyze button. So I have a low price of 75 to 100, high price of 140 to 180, middle price of 105 to 135. Now remember, I'll repeat, the return includes the dividend, so don't add it on top of that. So guys, I picked 7 stocks that I think will beat the market, and more importantly, they will beat the Magnificent 7 hype. It's my own personal Magnificent 7. So if you're serious about finding value in this market, you have to watch this video just to get around the mindset. I just picked those 7 stocks beginning of the year, and no, they're not hype stocks that everyone else is chasing. These are companies with real fundamentals, strong balance sheets, and more importantly, the price makes sense relative to the story, so it gives me that long-term upside that gets value investors excited. So go check it out and learn why they have the massive upside and avoid the overpriced hype out there. Click on this next video that's linked on the screen. Thank you for your time.